Investors are moving money out of US bonds as debt worries grow. It looks like the US government is going to have to pay more to borrow money long term, as the yield on the 30-year is still over 5% after the House of Representatives on Thursday passed a bill that's forecast to take the federal debt to 134% of GDP over the next decade, according to Moody's. That has sparked a steep sell-off in US government debt. Fiona Cincotta is a market analyst at City Index. Fiona, bond investors have taken spiralling US public debt in their stride for a long time. So why are we seeing this selling now?
I think there are a combination of factors. I mean, obviously, let's not forget at the start of the week, there's been very much the focus on the sovereign credit rating downgrade by Moody's. So it's almost as if the timing of that announcement combined with this bill being pushed through really just unnerved investors by more than it has, or more than we potentially they were expecting to be unnerved, and that's resulted in quite a market reaction. And I think this is also, though, part of a bigger picture of that sell America trade that we've seen that's been going on for quite some time. Whilst we did see a recovery in US stocks recently and the US dollar, that recovery has reversed again this week as we've seen that sell America trade take hold.
And coming on top, of course, of the trade uncertainty, is the US no longer a safe haven for foreign investors?
That's what the market appears to be showing us right now. Now, I'm not to say that that is always going to be the way, but certainly this week it very much feels that the US is not a safe haven. In fact, we've seen the euro once again benefiting from the US dollar weakness. The Japanese yen has also been performing well. And even cryptocurrencies, we saw Bitcoin at all-time highs as the market seems to be looking for alternatives to fiat currencies. So, I mean, it does feel like there is a shift away at the moment, given the sort of uncertainties that there still remain around the outlook for the US economy, the fiscal position, as well as the trade tariffs.
You mentioned that weakness in the dollar, which is down, I think, about 8% this week. Do you think that this movement is so large that it's threatening its status as a reserve currency going forward?
I think the US dollar will remain a reserve currency due to the lack of a suitable alternative over the long run. But that doesn't mean to say that we're not going to see blips where investors are sort of looking for alternatives to place their money, and we've seen that, as I mentioned, with the euro, with the Japanese yen, and even with the sterling, which is up at its highest level since 2022 against the US dollar. So there are definitely signs that investors are looking for alternatives, but I don't think over the longer term the reserve currency status is under threat just because of that lack of an alternative.
That government debt sell-off has spread to the bonds of other countries, including the UK, though, hasn't it?
Yes, that's right. You know, we have seen this impact the global stage. I mean, the US economy, it is the world's largest economy. And when we see impacts and marked movements over there, then they often do have repercussions for the rest of the world. As you mentioned, the UK, we've also seen some volatility in the bond market in Japan and also in Europe. So this is definitely something that potentially could affect and go on impacting the global markets.
That was Fiona Cincotta of City Index. Don't forget, you can watch more videos on Reuters.com.